in an investor's journey, often making less mistakes is more crucial than picking the right strategy. So let's talk about the various mistakes that can happen so that if you've not made those mistakes, you'll know to avoid them. Let me introduce my guest today. We've got Pankaj Mathpal, who is the Managing Director of Optima Money Managers. Thank you so much, Pankaj, as always, for taking the time. I asked you in advance what the key mistakes are that you found in your interaction with people over the years, and you've come up with a list. You've shared that with me. Let's take this one by one. The first one that you've highlighted, I think, is an interesting one because a lot of people tend to do without this, or rather to do this. They invest without planning. Why is that such a big problem?
Alex, good evening, and thank you very much for having me on the show. Alex, as you said, you mentioned this investing without planning. It is very, very important that you should know why you're investing, what is the objective of investment. It is like you want to go somewhere. Unless you know your destination, then there is no guarantee you will reach where you want to go. See, there's the importance of short-term, medium-term, long-term goals. So most of the time, when people do not plan, they invest anywhere in any scheme that may be useful, may not be useful. And for example, there's an importance of saving bank account as well as equity in your portfolio. So, or without knowing, if you lock your money for long term, and if you need money for a short term goal, in that case, maybe that you will take loan. So your money is earning a very small return, and you are borrowing at a higher rate. So when you do not know these things, that when you need your money for what goal and at what kind of products you have to select for that goal, it will be very difficult for you achieve that financial goal. So that is the first thing, that always plan, and based on your planning, then select the right financial products for you.
Absolutely. And by planning, it's simply sitting down with a pen and paper and writing down what you think you will need money for. It can be as simple as a new 4K television or even a new gadget, or it could even be retirement or buying a house, right, Pankaj? Now, exactly. The next one that you've highlighted is very important from the perspective, I think, of the equity investor, which is a lack of patience. Is this as simple as it sounds?
Yes, see, Alex, it's not only equity. Equity definitely is one, but for example, gold as well. See, people invest in some asset class, and for some time that asset class does not perform as per expectation. It may be real estate, for example. And then what happens? People exit out of that investment. So that is one. Second thing, because your expectations are very high from that investment, there is a cycle for every asset class. We see in the equity also many stocks. Investor buy, stock does not do well, they exit, and after that start performing, and then they regret for their decision. So you have to have patience. You have to understand that investment. You have to give some time to that investment. Maybe that, see, when you're investing in fixed deposit, you know that fixed deposit will give you certain return. But when you invest in anything which does not guarantee returns, you have to have patience, because it may be that for 2 years, for 3 years, the asset class does not perform. But after that, it will start giving you very attractive return. It may happen, but by the time you exit. So you have to have patience when you invest in any such product which does not give you guaranteed return, but which have potential to generate returns.
You know, this might be a little bit of a controversial question related to lack of patience itself, Pankaj. Now, in the recent past, you've had a few people that have spoken about absolutely amazing returns that they've gotten with cryptocurrencies. Do you think to a certain extent that people need to adjust their expectations, that expectations setting is the more important thing here?
Exactly, I agree with you. See, cryptocurrency, because you have now highlighted that, it's a different asset altogether. And see, if somebody makes money, somebody wins a lottery, somebody makes money in casino, does not mean that you start comparing those returns with your traditional investment. or the well established investment products. So cryptocurrencies are altogether different thing. And because there the chances of making money are as good as losing money. We have seen that many people, they lost money because many times we have seen that it has fallen by 50%. So that is altogether different thing. And investor have to understand that that is not a investment product, I'll say. Not like that your equity, gold or debt. That is speculation. So when you invest in time-tested products, you have to understand there is a cycle for that, and accordingly you have to invest.
Pankaj, the third one that you've highlighted is something that I think a lot of us are guilty of. We try to guess where is the Nifty heading, where is the Sensex heading, where is the market heading, and we attempt to time the market. But more often than not, we tend to get this wrong. So what advice would you give to people when it comes to timing the market?
See, everybody wants to buy at bottom and want to sell at peak, but it is practically not possible. So that is why it is said better than timing the market, spend time in the market. That is the better idea. And that is why we always suggest that invest in a staggered manner and get the benefit of rupee cost averaging. So timing the market is one mistake. People try to achieve that, but they can't do. And that is a mistake, which basically stop you achieving your financial goals.
Okay. Can you ever get it right though? And are there data points that you've looked at, Pankaj, over the years of strike rate? Because the thing is, I think people are equating this to what happened in early 2020 where the markets crashed and quite a few people got in at a low point. But that's not always happened. That's not always possible, right?
But that was incidentally, say, if you remember, 23rd March 2020, and when market fell, many people were that time so fearful, and it was difficult to enter in the market. And then we saw the kind of rally in the market. So when there's a bottom, then people feel that no, it's not a bottom. There will be more, like market will keep falling and they will wait for some time, and then market comes back and then they invest. So it is difficult. It's only a data which says that market was at the bottom that day. But how many people really invest in that day? It may be professionals, but in general, if you talk about, it's difficult to invest on the day when the market has fallen by the maximum number of points.
Okay, that's a fair point. The fourth one that you've identified is a failure to diversify. And I think a lot of people, again, are guilty of this because they expect supersized returns in certain asset classes. There have been a lot of people who have entered the equity market, for example, over the last couple of years because of the kind of success that they've enjoyed, but they tend to ignore the other asset classes. Why is it important to have a diversified portfolio?
See, each asset class has its important. Some asset class, they provide stability to the portfolio. Some has growth potential. So sometime when people see past returns, like for example, if we see equity return for last 2 years, so most of people, they will think that debt has not performed. So why should they stay invested in debt? They will even invest only in equity or more exposure in equity. But when equity market starts falling, then they realize the importance of other asset classes. So that is why you cannot time the market. You do not know that which asset class will perform. It can never happen that one asset class will keep performing always. We have seen in gold also, forget the equity because equity is volatile by nature. But in gold also, we have seen many cycles when gold has delivered good return. But that time people do not have their investment in gold. So that is why you should diversify your portfolio, means not like equal ratio, but in some asset class more or some in less. But you should have a diversified portfolio so that whenever that asset class perform, you should have investment in that. At the same time, when market falls, suppose you have investment in equity, market falls. So your portfolio should not fall by that rate. If the whole investment in equity and equity falls by 10%, your loss will be bigger. If you invest only 50% equity and 50% in other asset classes, your loss will be comparatively lesser. So that is why always diversify your portfolio across the asset classes, across the schemes, across the market cap, So diversification is the success, is the key of success to your portfolio.
Fair point. The next point that you've identified is getting emotional with an investment. And I think a lot of individual investors that have tried their hands at investing directly into stocks have found that it is very hard to dissociate with your emotions. When you've made a choice to buy a particular stock, you tend to get very attached to that stock, right, Pankaj? Those with a lot of experience will say that it's important to keep emotions at the door when you're deciding whether to buy or sell. How do you do this?
See, when you invest, there should be some data available for that while taking decision. It's not like that you bought some share and now it has fallen down. You are waiting because you say that for last 2 years I have invested. I do not want to exit out of that. If company has gone in loss, there's no point in staying invested in that stock. So whether it's a stock, whether it's a any even many times I've seen in insurance policy, even people know that they have taken a wrong decision, but they stay invested because they know that they have invested, and it's a quite long time is they're associated with that product. Always see if you have taken a wrong decision some point of time, don't be emotional, exit out of that. See, in anything, it's not even investment, in personal life also, we experience this thing. Sometimes wrong decisions are taken, but once you realize, as soon as you correct the decision, it is better. So in investment, it may happen that you have trapped in the wrong product, you have bought a wrong stock, but as soon as you realize this, exit out of that. No emotional attachment with any investment scheme, any stock, any product.
Now, this was a bit of a controversy for one particular ultra HNI investor. I won't get into the names, but investing with borrowed money. Why is this a very bad idea?
See, in some cases, it may happen that you are leveraging your portfolio, but I'll say in general, what happens when people borrow, they pay higher rate of interest than what they earn. Even if you expect good returns from equity, for example, and you feel that you will earn 12-15%, you're getting loan at 9%, 10%, even then, because there is a guarantee that you will pay that interest, but no guarantee that you will earn what you're expecting. So it may be a very big risk. So never do it. Whatever money you have, invest that with good planning, but borrowing money at certain rate and then expecting higher returns than the borrowing rate, it may be very, very risky. So that one should avoid. Otherwise, chances of making money are lesser than losing money.
Okay, fair point. You could, of course, get stuck in a debt trap, which is the worst case scenario in that instance. Let's talk about not reviewing your investment portfolio regularly. Now, I think a lot of people will be confused because often advisors say you should not look at your investment portfolio too often. Why is it a bad idea to not look at it regularly enough?
See, regularly and periodically are two different things. One is that people keep seeing the NAV every day. So that is not the correct thing. NAV of mutual fund or stock price every day. But periodically reviewing portfolio is very, very important so that you can declutter your portfolio. You can, the schemes which have not been performing and not able to beat benchmark even, you can exit out of that. Or you need to rebalance your portfolio. See, reviewing does not mean that only that exiting out of performing or not performing, but also balancing your portfolio. See, sometime it may happen that your certain or particular asset class has outperformed other asset classes. So you wanted to maintain a portfolio of 50-50, 50% equity, 50% debt. But because equity has outperformed during that period and your portfolio is now 70-30, it means you have higher risk in a portfolio than what you planned earlier. So when you review your portfolio, you can rebalance your portfolio, you can correct your portfolio. So reviewing once in a 6 month, something like this is very important. And it is not for the investment, everything like insurance, investment. So for the purpose of diversification, asset allocation, reviewing portfolio periodically is very, very important. People don't do it. And then they realize in a longer term that they have taken a wrong decision. they have taken a higher risk, or something like that. Investment also, when there was time to book some profit, they didn't do it. So there's importance of booking profit as well.
Absolutely. And the last point, and perhaps this one has to go a little quicker, we're running out of time, but Pankaj, taking too much or too little risk. Too much is understandable. You shouldn't go overboard with the risky investments like equity, for example, or even to the further extent, talking about cryptocurrency. But too little risk?
See, too little risk, many times people say that they will not invest in equity, for example, they will stick to the fixed income instruments. But that may become more riskier, because in long term, when you want to achieve a financial goal, you reach to a certain age and you do not have sufficient money because of inflation and taxes, you could not accumulate what you wanted to accumulate. So that is more riskier. So that is why some risk one has to take. One has to understand the product, but you have to understand that if you do not invest in certain things, maybe in future when you need money, you will not have sufficient money for that financial goal. So that is why taking too less risk may become a very big risk for you.
Absolutely. Thank you so much, Pankaj, for joining in. And hopefully a lot of people have benefited from this conversation. Always a pleasure speaking with you.
Thank you.